What's up, everybody? Welcome back to Ask Me Anything Happy Hour, where we are here to answer all of your questions and have some fun doing it. We got the Brady Bunch of Money Multiplier and BYOB in the house, ready to go.
I just had a great call. I have been trying to refinance one of my properties for literally 8 months, and the lender is terrible. And they finally got everything closed, and everything's good, and the terms are better than I expected, and with the rates. So I just got that call, and I'm pumped now because I can finally get cashed out and get some money back. And so that's awesome.
Congratulations. That's awesome, brother.
Thank you.
That's what you thought of, huh, Snaggy?
Is it
Right.
the curls?
I mean, I'm not that far. Step back. I mean, it's pretty close.
Bug your eyes out a little bit. Let's see.
That's hilarious.
Always having fun.
Who else we
Well,
got?
good. What questions do we got today, guys?
Carson, I feel you on that, man. I spent almost 5 years trying to do a refi through a bunch of different companies, and it finally went through, and it was such a relief. And like Brent calls it going like through, I think, a colonoscopy exam or it's some funny saying he's got, but it's such a headache, but sometimes we got to play with the banks until we're able to just fund everything ourselves, right? Eventually cut them out like Nelson Nash teaches.
Yeah.
But I feel you.
Yeah, and that's an interesting topic. I'm glad you brought that up because I talk to other real estate investors all the time, and they're like, "How do you grow your business and be the bank, but also buy properties?" It's like, well, every time I buy a property, if I could do it all cash through my policy, that would be legit. I'm in. Let's do it. But in all reality, you don't have liquidity to scale a real estate business to do that. So like, there's kind of a fine line of how much do you actually be the bank versus just scaling a real estate business. They're kind of two different things you got to mash together, and it's totally dependent upon the person and their situation. But I think like with Nelson's way of thinking, like long term, you can do that. You can do that for your kids and grandkids, 100%. But to start and grow a company, you can't really do it. It's kind of hard. So it's fun, and eventually we'll all be the bank, right? Think long term.
That's a great point, right? Like Nelson's example when he talks about equipment financing, he's talking about really front loading it for the first 4 or 5 years where he's putting a lot in. He's capitalizing the system. So when Carson's talking about is we have to really think long term. Like I have someone right now who's really wanting to recapture all this money, $1,000 a month he's spending on a van. But it's like, look, you either have enough to put in, capitalize your system, pull a loan out, pay that off, recapture it, or how about you just build it up over the next time because you're going to buy more vans. You're still pretty young. You're going to have 6, 7 more vehicles you're going to finance. So if you can't recapture that today because you don't have the means, it's like any other business. Like we have to think that long term and can't expect our business to be profitable from moment one. Why? Take 2, 3, 4, 5 years, depending on how it's structured, right? So
to that point, we'll just kick it off with if anybody wants to talk to anyone on our team, go to mentors.beyourownbanker.com if you're ready to get started with your own bank. Grace said, my question is, how can I use my own bank in the following situation? And when or where should I raise funds? She may soon be starting a business entity at age 66. It's her answer to being employed. Start out doing demos and classes at the town senior center and then collect names of interested clients to do like skin stuff. So I don't know. She's saying, if I receive donations to raise funds for my entity, I don't know that people really do donations, but she does stuff like that, like kind of, trying to go out on her own to do that type of stuff, and how can she be her own bank in that situation? To start a business at the age of 66, especially it sounds like a lot of service stuff. So Reiki, skincare, massage.
I mean, awesome that you're doing and offering all these cool services, right? Like healing, energy healing, massage, helping people take care of themselves. I mean, we have to love ourselves first, pay ourselves first, right? Before we can help anyone. It's like anything. Like we talk about, we have to be in 2 businesses. The first business, the business of making money. Like I would ask you, are you charging for your services? I don't know anyone here, but if someone tells me, hey, I'm really good at this, I've been doing this for a long time, and I'm like, cool, what do you charge? Oh, I don't charge. I don't want to do a call with them for anything, right? If you don't value your time enough to charge for what's worth to that person, like find out what your services are worth to someone, create the business, and then you start that, and then you can start the banking business next. That'd be my first thought.
Yeah, focus on the business and the cash flow there.
Yes. Focus on creating money to have to have the ability to create another business. Remember, we talked about it. Carson talked about it. This is just another business that we're building, that you become the banker. We say becoming the bank all the time, and sometimes I think that's misleading. I think it's becoming the banker, the verb of banking, the process of the verb, not the action of being the bank. Like, you get people, I hate the bank. I want to be the bank, just because they don't want to deal with the bank, because the bank sucks in a lot of cases. But
the other than answer that question too, because I recognize that client, I think, is if you're trying to raise funds to fund infinite banking to then fund your business, there's kind of a lot of moving parts and pieces and potential risk as well. So it's got to kind of be very aware of that and be cautious of that to a degree, because the other way to look at it is, have capital, raise capital to start the business. When the business is profitable, have the profits then fund the infinite banking, because now you're putting your profits to work for you. Now, Gabe, you can probably talk more about that, being a business owner and doing this.
Yeah, a lot of things were going through my mind. So for me, I was practicing jiu-jitsu maybe 5 years before I even thought about opening a school. But there are different avenues to be in the industry. I could have gone into being an athlete or just being an owner or being a program director. But if you want to do the actual services, just like Jason said, you have to be able to make money in doing it, right? Are you already cash flowing? And what I would say with the infinite banking, you have to think like the banker. Would a bank underwrite that business? Would a bank actually approve a loan on that business? And if not, then it's probably a hobby, right? So then you can still deliver the same kind of services to people, but maybe you hire the people that can actually deliver the services and you just are the business owner. Is there something you like doing just because it fulfills you? Then but that's the flexibility with the infinite banking too, is I had some money from real estate deals, from cash flow and properties that I used into a policy to now fund my business. So I don't care if I make money or not. Obviously I want it to be profitable, but I'm still going to do jiu-jitsu regardless. And I want this place to exist just because I want it to exist, right? So that's where they can go together. But with a money mentor, we can do a strategy call to help you look at the numbers, and we'll give you a realistic projection. And we're going to be on your team, and we'll be honest with you. If we don't think, hey, maybe not just yet, it's time to start a business or use a policy for this. We're not going to sugarcoat things just to get you to get a policy, right?
Sometimes, most of us heard about infinite banking and then took 2 years to act on it. So like, if you have to spend a couple of years working on a couple of years on your business and then act on it, like, we're here for you for sure. And then again, if anybody wants to phone call with our team, it's mentors.beyourownbanker. See, Megan Stevens is saying, this was answered for me, but thought I would ask here in case anyone else has ever wondered. The MEC line is written pretty closely when setting up policies. Would a dividend ever MEC a policy?
no, not the way we're setting them up. We're setting them up not to MEC. You have the PUAs. You have your dividend buying more PUAs. So that's all considered in all the calculations that are there.
What if you max paid PUAs every year? Could that even be possible for it to MEC?
No, because you're still underneath the 7 pay line. They're not going to let you MEC it in that year. So the next year when you max, it'll be just less.
I would even think that there's a little bit more, like everything with the life insurance companies, like the more we learn about them, the more we understand why they're so successful. They're super conservative with all the projections, all the numbers, at least when you're talking about specially engineered whole life, not the IUL fantasy land, but an especially engineered whole life. They're really conservative on the guaranteed side. They're really conservative on the non-guaranteed side and what they're showing. And so when we're designing them, and then we go back and ask the questions, I don't think there's any way you can MEC. And if you do, there's things that the companies do. They'll send you a letter and say, hey, you MEC'd your policy. Did you mean to do that? And it'll tell you everything that that means. And it'll tell you how to unMEC it and return to a non-MEC status too. So great question, but I wouldn't worry about it.
Yeah, because Craig was saying that he's had a policy for 15 years with one of the companies, and the cash value in year 15 is like quite a bit more than the projected. About like 8,000 more than the projected in his illustration, and that means because more dividends went in, right? So it didn't MEC the policy, and it actually had more dividends than forecasted.
Interesting.
That's amazing.
Yeah, I've wondered, and this is probably something we'll ask the insurance company now that this conversation happened, but I've wondered if maybe the dividends don't even count towards that MEC limit because they're kind of exempted from it maybe. But I don't know that for sure.
Really either. No.
And for
I
those of
wouldn't
you,
think so, but let's find out.
yeah, we should find out. And for those of you on this watching that have no idea what the MEC limit is or dividends are or what we're talking about, I understand you and I feel you. We're talking about how we build whole life insurance policies for banking. So that's a whole different conversation. We can dive into those little details later. If you do understand this, awesome, good for you. But don't get left out.
Carson, it's a modified endowment contract. That's what it means. think of it this way. There's a line. There's this line right here. If you go above the MEC, all of a sudden you have a silent partner again. You become a qualified plan. It's a taxable event. You now have the government, Uncle Sam, putting his hand this way again, being like, hey, I want mine. Right? If you stay below it, right up to it, like we design them, think of it as a max efficient contract. We're going to bring you right up to this line, but not over it.
So Dusty Showers, Pets, Tips, and Animal Rescue says, I'm new, but I have had a conversation with Jason, and I mentioned this to him. I have a pest control business. I'm wondering if I can take in the revenue and run it through a policy and then put it back in my business without being COLI. So just personal to business to personal to business.
Depends on how you're set up. If it's an LLC, if it's sole proprietor, at the end of the year on December 31st, you're going to pay taxes on everything. So it really doesn't matter if you roll across the water each way, back and forth. But if it's an S corp, you're going to want to keep it on the right side and confer with your accountant.
Yeah, I was gonna say CPA question, because once you start crossing bank accounts and stuff, that you can get into trouble with the corporate veil. The whole reason why you have an entity is for protection of your personal assets, and once you start having funds going from business to personal and personal to business, that corporate veil can sometimes not be there anymore, and then you're open to liability. So just be very careful and talk to an attorney or CPA about that first.
And tax implications too.
Yeah, and Dusty, I can tell you, like, again, with the CPA, you have to find a CPA that knows this. Like my CPA that I work with, not the one that runs our fractional CFO program, right? Zach Newberry, like he's awesome. Like he understands this, he applies this, he can do this. Like I was mentioning in our text, Dusty. Like for me personally, I actually, we're taking, what's it called I just forgot what it's called. I had the word a second ago. But like my accountant was like, well, why are you taking all this money out of the business and putting it into personal policies and life insurance? You have to pay taxes on it. But I'm thinking long term. I didn't care if I was paying taxes right now on it. I'm not even necessarily using it. I'm using it to pay our payroll taxes policy and other things like that. But there are the tax implications that we're talking about, right? And they're personal policies. I'm using my personal policies to do business things, but there are tax implications to it. It's not cheap either. So
all things being equal with the entity structure, and Brian hit on it. He said, take your profits and put it into the policy. I've been looking at some of the best strategies to move the money for my business in policies. And what I kind of came up with was like savings first, put your savings into the policies, then profits, and then eventually, like Nelson Nash teaches, is all your income will flow through. And I would love to have all my expenses, all my inventory, salaries, everything paid from policy money, whether I loan it from my policy to the business, and then the business pays it. That way, it's a business expense, so it's deducted, but then also the interest that the company pays to borrow the money, it's also a deduction. I just wouldn't want to get too in over my head and try to put all my revenue in it and then have some kind of cash flow interruption and you get a little stuck, and then maybe you have to take on different debt. So, but again, we're not financial advisors, but that's how I would like to do it, and how I feel like makes sense for me is put in your savings first, then scale with the profits. Then eventually, once the policies get big enough, you can start putting all your revenue in it.
All right, Matt saying, hi, so how do you guys plan for expected dropping of household income when thinking of how much premium deposits should be? We have more cash flow now, but once my kids are old enough, we'll be going down to single income household to keep them out of low security prisons and government indoctrination centers, which I think is his way of saying homeschooling maybe or something. I don't know.
People have to understand that after year
Out of college.
all of our policies drop to just the base. So if you start off with $1,000 a month, 12,000 a year, that's only for 10 years. And then the term falls off if added, or the PUAs falls off, and now you're just doing base. So now it's a quarter of what you were originally starting with, or somewhere around there, depending on how the policy was built. It just goes down to the base.
So Joe's saying you have flexibility. You have flexibility on how it's set up. But I would also say I would challenge your thinking a little bit in this. Like, I'm reading this as someone who, like you said, you're going down to single income, but are you guys really looking to lower your lifestyle and everything else too, a couple of years from now and live more scarce, not be more abundant? So how could you do other things that create more cash flow and do other things with the policies, right? Like how could you have a better lifestyle on one income, or maybe make more on one income?
We teach you to get out of debt and then start moving your money. What are you going to move your money into? Different investments. Investments make you what? More money.
Well, also, okay, I had the same thought, Matt, when I was trying to pick my number for the first year, but then ultimately it depends on how old you are too. But after 10 years, they all go down anyways, correct?
Yeah.
So like I kind of had that like mentality of like, can I afford this at least for the next 10 years? And then they automatically, the premium deposits are less on year 11 there forward. So I'm not sure how much time frame you're looking at.
In the first 10 years, I'm already over 4 policies. So, I mean, you're just talking one policy for 10 years. And if you keep doing what we're supposed to do, the way Nelson says, you're supposed to keep purchasing more and staggering them, and that's going to be making you more in the long run also.
Yeah, so you could also work your bank to plan for that expected drop of household income by putting it to work and then starting to just make it so that you balance when that time comes. Okay, Eve is saying probably a Hannah question. How long after someone has suicide idealization on their medical record could they be approved for an insurance policy? What about drug use and now sober, asking for friends? That's a great question.
I mean, it's a pretty easy answer. We would just go to preliminary underwriting. Like, get as many details as possible. Have your friends share as many details as possible, because the more we know, because they're going to come back and ask us certain questions and let us know, is the person insurable or not. It's pretty easy. We just email the insurance company and ask them.
And one of the biggest factors is time between those situations and today. Because I've dealt with this on a client here recently, and it was drug use and all that kind of stuff. And I think it's going to vary between person in the situation, but it was 5 years and they were okay. And then another client where they'd had something that happened like last year, and so they couldn't get a policy. So just reach out to one of us, we'll get the information and ask, as Jason said, preliminary underwriting, and get that answer back.
Yeah, something simple like this, Eve, you could email Hannah or any of us asking the question, and we can just go to preliminary underwriting rather than having a whole call and everything. We can just start gathering some information. Sometimes you don't need a full call to figure something out, right?
Yeah, but I appreciate you asking in case anybody listening also, has those concerns. David is saying, hello, all. My policy anniversary is 1 month from today with One America. I'm wondering what to expect. Will interest and dividends be added to PUA that day?
Linus, what do you think?
Well, David, the way I'm reading your question, the first thing I'm going to say is interest and dividends get added to the full amount of premium you've put inside your policy. And so you'll see that, in fact, the insurance company will send you an annual statement on your renewal date as well. Now, as far as what to expect outside of interest and dividends, if you're on an annual premium, they're going to send you your bill for the annual premium. And if you have a policy loan out, they're also going to include that policy loan interest kind of on a separate part of that bill. Those are my thoughts. Anybody else?
Linus, doesn't One America put the interest into the policy day one the loan is taken out?
Yes, but if that policy loan wasn't paid back, I think there would be an outstanding policy loan interest bill. But right. I don't have a One America policy, so I'm not sure on that.
It'll show you, David. So if it's monthly, it'll show you your premium. It'll show your PUA. and it'll show your loan interest owed, like right when you get that. So, but I think he's asking too, will he earn dividends on that day, which I don't know exactly. Is it at the end of the year that our dividends are paid, right? It's not at the end of your policy. And I think that's the second part of the question he's asking.
I actually think since you're within a month, you might be able to see a good amount of the stuff on your dashboard too. Because like I have certain policies, not with One America, but that are coming up on their annual anniversary, and I kind of log in there just to see, what it looks like. So I would suggest peeking around, but we can definitely help you, I'm sure. If you email us offline.
Yes, your implementation specialist can answer all those questions better than any of us probably.
Yeah.
They work with that every day.
Yeah. I also want to say a shout out to Damian Robinson. He just started his second policy and he's in Colombia. I wonder if he knows Noah and Christy Harris. Okay, so Kristen Thompson is saying, what's the email address for coaching? Would that be you, Snaggy? Okay, we're going to say for coaching, snaggy@chrisnoggle.com. Put it in the chat. Just a man is saying, how can we start with very, very little savings and only a few hundred cash flow a month to use to put in each month?
Probably need a little bit more information on like your age, gross income, those kind of things. Those are sort of the things behind the scenes that we have to use to see what we can do for a policy. So
I think in the meantime too, what Craig Yenny from our team does is just act as if you're doing it right now. If you have a few hundred cash flow a month, just start setting that aside and just make sure it's sustainable, and that realistically could be something.
I was going to suggest financially weighing in, just a man. Like get a full, if you don't have a full picture of where you're at, where your money's being spent, whether it's expenses, lifestyle, future self, really get all those numbers dialed in, write them all down, track them for a while, and then like Shauna said, act as if for a while. Start paying yourself the amount that you want to be putting in as premiums, and just prove to yourself you can do it, because that progress will have you feeling really good about yourself. It'll lead to happiness, right? And then you can start working from there towards putting a policy in place.
I'd like to add one thing too, that
No,
this is a deposit. This isn't a bill. So it's not really how much are you running through on a monthly basis. It's what is being left in on a monthly basis. So I just built $1,000 policy and they were leaving in $235. So they still had the ability to take out that $770. So they, it depends on all situations, but it's not what you're putting in, it's what you're leaving in. And the ability to run through is what makes you the interest.
Again, I'm just going to put on the screen, though, anybody who's interested in talking to one of our mentors, it's about, I think, 45 minutes long is the call, to video call, one-on-one, mentors.beyourownbanker.com. It could be a phone call, too, if you don't understand how to get your video working, so no worries there. Navigate Your Ventures is saying, if my trust becomes the beneficiary of my personal policy, then do I still pull money out for investments like before, or is there an extra step involved?
Is it a revocable trust or an irrevocable trust? That's first question. Second question is, if it's irrevocable, then the trust must pay for the policy. If it's irrevocable, you can bring it in and out and kind of run either way you want.
I'm wondering a little bit what really that question is. If he's asking about the trust being the beneficiary, that could mean he could still personally be the owner and the manager of the cash value.
Oh, so it's not the owner, it's the beneficiary.
Yeah,
That's what the question says. Yeah.
Oh, the beneficiary means nothing. Yeah, it's the owner. It's the owner of the trust. So yes, you can do anything you want if you're still the owner.
And it wouldn't be through your trust, it would be just through you.
Correct. Yeah, exactly.
Because the trust only gets involved when you pass, essentially, and your death benefit gets paid out.
Yeah, the beneficiary is nothing until you stop breathing.
So from a past AMA, which is Ask Me Anything, do we know if company-owned life insurance is protected from lawsuits, in particular in Florida? So is COLI protected from lawsuits in Florida?
I know in personal policies, Florida's fully protected. It's one of the 37 states that's fully protected. I'm positive on that. As far as COLI, I mean, it's all state regulated, so I don't know if there's different guidance for it. I'm not 100% sure. I would think so, but I don't know for sure.
Yeah,
Have you heard anything about this, or Linus?
Go ahead. I believe it's the same, but I can't tell you for sure. Go ask your attorney. They should be able to know and find out.
Florida's pretty protected, but I'm not an attorney, so.
All right, one more shout out. Just from Drew Hitchcock, just an update. The new policy finally showed up in my back end 3 days ago, Jason. So congrats there on a new policy. And then Tracy, hi Tracy. She's saying, why more policies instead of just putting more and more revenue in the original policy? And this is a great question.
Tracy Ann, can you put 16 ounces of water in an 8-ounce container?
So
Simple.
ideally you would pay back whatever, right? And then when you have a surplus, that's when you start the next one.
Yes, I mean, we do teach. I think it's a little bit more like once you have a policy in place, you do want to put as much paid up additions back into your policy once it's enforced as is allowed every year. That's going to make your policy the most efficient and increases your death benefit, your cash value, everything else. But there's going to be a certain point where you can't stuff anything else into it. And that's why that business has become so successful, tying it all the way back to the beginning of our conversation, that it's now time to open another business, like open your business on 3rd Street, 5th Street. That's why there's so many banks with the same name in your town.
It's true. All right, I'm going to end my portion of it with this question, okay? And then you guys have to continue on forward. So
I have control too, by the way.
Okay. Perfect. Okay, so after this one, you got this. So Darius is saying, is it possible to buy lapsed policies that have cash value? I'm guessing there is, and I'm sure there is a waiting list. If so, let me know. This is a fabulous question.
You can't buy it if it's lapsed or it's gone. But right before it's lapsed, there's people who do want to surrender their policies that you could step in, pay them off essentially to buy the policy. You could pay them, a portion above what cash value they have available, so they get something out of it too. And you get now a fully funded policy, possibly years into it. It's a great deal for both of you. So yeah, there is a waiting list to do so. A lot of us are doing that too. So yes, if you want to email us your information, we'll add you to the list and what you're looking for.
And I'll even add to that a little bit. Elapsed policies can be brought current by the existing owner, typically within a certain time frame. Is it a year, maybe 2 years? I'm not sure. Like they have to catch up premiums to like bring it current again and then sell it to you. So maybe something is possible there, but not all situations are the same with that.
Yeah. Thanks, Linus.
Can a qualifying exam for a whole life be performed in Alaska? The answer to that one is definitely yes. I've done that multiple times. The companies that do the exams both operate in Alaska, so we're good there.
Perfect, Linus.
Shauna's chiming in.
We are the best. Look at that odd screen and in the chat. So, nope, we're at the end. Anybody else have any cool calls they want to talk about, questions, things that came up this week? You went away from the man bun. That one comment that said a big X on the man bun told you to put your hat on.
No, I just kind of hurt my head actually. I was kind of over it.
Got a little too tight?
Yeah.
I tried, but it didn't work too well.
I tried, it all came off. In fact, when I was your age, Carson, I still kind of looked like this. So
that's awesome. Linus, you could do it with your beard.
He's got some good hair too. He's probably pretty close to being able to do a man bun. So
No, not at all, Jason. Not at all.
No,
not at all. Dude, my brother-in-laws would disown me, man.
Let's see, Terry says, if you max all PUA, is that when you open new, or do you pay all loans back also? Good question. What do you guys think?
Depends when money's out.
Yeah, it depends. For me, I would say if you have more income every year you want to run through your policy, I'd go pay more premiums. I'd go get another policy. But if you don't, and it's like a one-time thing, you have some extra cash, just pay back loans. That's completely fine too. But
That's an interesting question. I get that one actually quite a lot. Like, what is the best use of the money sometimes, right? And I just say it depends on what you're trying to accomplish too.
Yeah.
Like if you're looking to protect the family, then maybe it's opening another policy. If you're, like you said, Carson, just having a one-time windfall that's coming in, and maybe you're paying that loan back so you can use it again, right?
Yeah.
So,
yeah.
Let's make an example. Let's say you're doing, $10,000 or $20,000 a year, and you've been doing it for 4 or 5 years, and you have that $100,000 out making money in investments. So if that money came back, it would be able to backflow into your policy. But that interest needs a place to go, right? So in that case, you definitely would open another policy. If the cash flow coming in would overflow if all the money came back, then yes, you would open another policy.
Here's a question: how much could your child's policy be?
What does that mean?
It's a great question.
Yeah,
Great question.
there's a little bit more to that answer though, but
$25,000 a year.
Yep.
There's one answer. Now,
And premium?
yeah,
Devin did 50 on his kid.
Ariana's got 25
Yeah.
a year.
It's going to depend, right? It's pretty hard to put that much into a kid's policy to get approved. I mean, you're a lot of times you're.
I
this is
answered
the general rule of thumb. It's reverse engineered based on the total insurance on either the mom or the dad. In most cases, it's usually up to half, up to $1 million for most of the carriers we work with. If we can write a reason why you can carry that much more insurance, you can get people to consider that. That's going to be more about planning. Like the parents are carrying way more insurance on them. It makes sense for an estate perspective to be able to carry that much insurance on your kids, because usually you're not able to put more than $10,000 a year on a kid's policy. Sometimes it's going to be 4, 6, 8,000. Just depends on how old the kids are and all these things. A lot of variables.
And Jason, you can't get a child's policy unless the mother or father has insurance also.
And you cannot unequally insure your kids. I just actually was working on this during our meeting earlier, putting together policies from 8 years old up to 17 for 4 kids. And the equal premiums range from $250 a month up to $294 a month to have them all equally insured. Right? So it's pretty easy to do, but it's all reverse engineering. And like how's this? I talked to a guy earlier that he was a super nice guy, nice man. He was a pastor. He was a security officer, a little bit older. He took custody of his now deceased daughter's youngest son, who's 8. Right. And so tragedy there, but now he wants to leave him in a better place and set up a policy for him. Carried very little insurance on his body, like $20,000. And so when the kid's 8, putting $100, $150, $200 a month into the policy, put like almost $200,000 on him. So like a potential workaround there would be, okay, well, let's do a term for him so you can insure the kid, right? If he didn't have the kind of money. So there's ways that we can get creative depending on what your goal is. His goal is very clear. I want to leave legacy for my youngest grandson, right? So
yeah. I'm doing 5 policies right now on a family of kids, and they're all $100,000 or less death benefit, and the grandparent is the one that's going to own and fund them. And Linus, you're the one that kind of pointed that out, or sent over that thing. I was reading through it, but you can do that without the parents being insured.
Yeah, I'm curious too, Joe. 25 a year on your daughter's policy. So what's the size death benefit on a policy like that?
Started at 2.2.
Interesting.
Casual Credit Gaming says, how do y'all value peace of mind versus having the money always working? I never used more than half of my cash value because I know it's there in case of a catastrophe. That's just reserves, having a reserve set aside somewhere in case something happens. 6-month reserve, 12-month reserve. Yeah, having inside a policy is a great place to have it.
Depends on your cash flow. If you're cash flowing $20,000, $30,000 a month, how much do you have to keep in reserves because it's coming in?
I like their question. How do you value the peace of mind though behind all of it? I think it's good to have reserves. I think it's good to have money out working for you, but you want to make it easy for you. If it's too complicated, it's not worth the time. So I think it's really something for you personally to figure out. And it sounds like you have a good plan. If that's what you like.
It makes you feel warm and fuzzy. Stick with it.
Mindset and math, always the 2 parts of every conversation. So
yeah, some people might want a 50% or 6 months, 12 months of liquidity in their account. Some people might want 2 months because they, like you said, they know they got cash coming in and they're comfortable. So, and I'm sure it'll ebb and flow every year based on your income and investments.
And I like what Casual Credit Gaming is doing, though. They're keeping all of that extra inside a policy for liquidity.
Sure.
Most people are still leaving it sitting under their bed, in a safe or in a savings account, thinking that's the quickest way. But we know the banks don't keep their money there, right? So
where do we want to warehouse our wealth? In the policy.
Okay, in our privatized banking. And we're not all riverboat gamblers like Joe. So, some of us are a little bit more conservative.
Go for it.
Casual Credit Gaming just replied and said, hypothetically, $20,000 a month of cash flow. How safe is that? Is it from an investment? Yeah, Joe's example is referring to investment income, passive income, probably, or just consistent business income. Yeah.
I'm just throwing 20,000 out. That's not me.
Yeah, add a zero for Joe.
It's just hypothetical.
That's kind of fun. So Brianna says, just did 5 today for a family with kids. Best legacy building and protection. Absolutely.
So that's my business partner. That's Brianna. She's part of my team now. So if any of my clients out there get a message or an email from Brianna, she's on my team. So, hi, Bri.
What is the IRS limit on each policy? That came from Tracy and Gibson.
What is it? That's the MEC limit.
Yeah.
Yep.
That's on the structure. It's a great question. It's an interesting question, but it's on the structure. So it's going to vary on every single person.
Yep.
Yeah, age, all that kind of stuff.
That's why they're socially engineered. Even if you have the same conversation, the person, like say you talk to 5 people in a week and they all make exactly the same. Well, depending on if they're male or female, depending on how old they are, depending on other factors, there's all these other variables that are how much other insurance they might have on their body.
Yep.
There's a whole bunch of different variables.
Total death benefit.
Yep, that we're considering just to be able to pick like where, because remember, we're not beholden to any one company. We work with 5 different ones. We work with 5 different mutually owned dividend paying, cash rich whole life policies or companies, because we want to make sure we can solve the problems that are coming up. So
that's good, Jay. That's good, because people should know that there's more than one bubble that we have to build these policies and make work. So it's your income, and you can't put more than 25%. And then how much income times how old you are. Are you 30 and that's times 30% for a death benefit, or are you 60 and that's only times 15% or times 15 for the death benefit? So if we build a policy, it has to fit in this bubble, this bubble, this bubble, and this bubble, so everything works. So it's not just like one little button and say, okay, all done. There's a lot of things that go into it.
Joe, it's good you brought up, and we don't talk about a lot, but that Joe's talking about the human life value. I don't love that term, but the reason why these companies are profitable for so long is the actuaries know when you're going to die.
Yep.
Like almost to the minute. And they're not following you around and like knocking you off, but they know. They've just been studying science and all the different calculations that go into it. So that's part of the consideration as well. We need to know, like if you're really young, like, you look at some of Devin's policies, like I couldn't have those same policies. I can't carry as much death benefit on my body unless I'm making more than Devin, because I'm going to be 50 this year and Devin's still in his 30s, so he can, and same with Carson's a better example. Like Carson can carry a lot more death benefit, and a little bit of money is going to give him more death benefit than it would me or old man Joe,
Yeah.
Which sucks because they can't get as much money into it as I want. Maxed by the death benefit.
Gotta make more money.
Make more money. But how do you make more money?
All right, let's walk through some of these last questions here. Antonio said, my mother could not be approved for a policy, so if she takes one out on my life, she can be the banker and build her policy off of my life? Short answer, yeah, absolutely.
Yep. Antonio, you would go through the process, and at the end, then you would transfer ownership to your mother, and then your mother would be able to utilize your policy by utilizing your life as the insured.
I've done it twice this year. Helped a guy, get started with his son, who's a firefighter, and then just helped another woman get started with her son, who, qualifies preferred non-tobacco. But you have to have that relationship with your parents too. Like, hey, because you're not going to literally be able to own the policy on them, most likely, right? They're going to own the policy. You can just be the one funding it and stuff. And then once in force, you can change the assignment if you guys have that agreement. So
Brianna did clarify here, 20-25% of your annual gross. Actually, for Lafayette, I had someone who was doing like 40%, but they're an extraordinarily high net worth, high income earner. And then the company's going to go through some more underwriting to do that and verify. But yeah, if you're a very high income earner, you can do more than that actually with some of the companies. Let's see here. So Casual Credit said, if you got a policy on your first kid, then have another kid 2 years later, let's say, does the face amount of the policy on the new kid need to be equal to the original face amount for kid number 1?
Oh.
Well, the rest of it says or now, because if you think about it, the death benefit on the first kid probably went up over those first 2 years. Yeah, it would need to be equal to the current death benefit, but there is some wiggle room there. So it's just a matter of custom designing it to fit.
It's all going to be dependent on what your annual or monthly deposit's going to kind of be about, especially if you're going to get it when it's a newborn. You're not going to be able to put in as much as a child that's 3 years old.
And we can always ask the underwriters too ahead of time and say, hey, here's the situation. What's the minimum, maximum premiums and death benefits? And we can get an answer ahead of time.
Sure.
Amon said, my wife is a stay-at-home mom, so policies reduce human life value if someone isn't working.
If you're married, the wife is eligible for 3/4 of the death benefit of the working spouse.
And the working spouse typically has to be insured or uninsurable. Is that correct, Joe?
Right. Yeah. Well, no, just has to be home. So if Armand has a job and he gets a death benefit of $1 million and the wife stays at home, doesn't matter if she's not being able to work or not, just a stay-at-home wife is eligible for 75% of the death benefit of the insured.
Sometimes more. If you write a letter, right, kind of explain a cover letter, why, and explain why from a estate planning, who they are, why they want that coverage, all those type of things, like what hardship that the husband might have if the wife passed away, then you can get approved for closer to their total death benefit. So
yeah, I believe the companies we work with will allow for the non-working spouse to have the same amount of death benefit as the working spouse up to certain limits. So maybe $1 million, maybe $2, $3 million before it becomes less than the working spouse's coverage. I know we got my wife approved for more death benefit than me, but that's because I have a lot of kids. I would have a lot more to deal with if my wife passed away and I need to quit working to take care of my kids.
And then Antonio had another question. Will that policy reduce my human life value coverage for future policies? Yes. So if someone owns a policy on you, you're the insured, that death benefit is applied to your life value. So
Elizabeth asked, what's the physical like to get a policy? Go rapid fire. What's the physical like to get a policy? I'm 59. It's simple. it's height, weight, blood, and urine, right? It's making sure you're as pretty on the inside as you are on the outside.
Knight of Israel, do you have a list of whole life insurance policy companies that have the ability to do an IBC in Utah? Well, most of them can do a policy in any state, New York being the one off, but yes, there's multiple companies that can do a policy in Utah, and all the ones that we work with can do it.
One America and Lafayette are our go-tos.
They order medical tests for kid, open a new policy? No, usually they do not do that for kids. So, but you do have to sign, the guardian has to sign something, a medical form for the kid. And so I've had situations where a child has had medical issues, and so that does come into play. So the parent has to disclose if there's been anything in the past on the child. In this case, they had a lot of medications and some other things done, and the child was not insurable. So you have to disclose it, but no medical.
So just ask for during the application, it's best if you provide your pediatrician's information and all that kind of stuff. So that way the insurance company can follow up with them easier. That's all. Just full disclosure. We're trying. Every insurance company, again, they're not willy-nilly. They're not profitable for every year they've been in business because they're just like, hey, yeah, we're all going to be partners. They're actually going to look at you and see who is a good partner, who has good habits, who's got good health, all the things. So lower the risk.
What does the dividend maximizer rate mean?
This is not like a name of a thing that we created. What is this?
It's inside the AUL contract. You'll see it's referring to how much of the dividend. I have to look.
Isn't it tied to the indexing?
Weird.
Isn't it tied to the indexing piece? No.
It's different.
I had to go look it up many months ago because it never comes up. But I'd have to go back and look it up again. I don't remember off the top of my head what it is.
Yeah, it's weird.
I don't think it's called dividend maximizer rate, though. I think it's called the dividend crediting option rider, and that's something else. I think maybe this is a piece of an IUL that.
I was just going to say, isn't that for an IUL?
Maybe.
If Chris was here, he'd get angry. He would know.
Did that come up on your policy, James? He's actually an in-force client right now, by the way.
Yeah, so he popped in there, a rate that we declare each year that is used in the calculation of the index dividend crediting option.
Yeah, that's
right.
This is the annual rate of return in the index value. So I don't know. I mean, go ahead if you want to explain that.
I mean, the indexing means you're tying your dividend to the market, to the index fund, which we don't really recommend. I mean, you can do whatever you want, but we're saying, hey, have it buy more paid up additions because that gives you more cash value, more death benefit. Every time you do that, it buys you a little mini policy that's designed pretty much like your original policy. It just helps you pay.
It's an option you can choose to have your dividend go into, which I don't know anybody that's doing that, by the way.
I'm doing this so I'm not in the stocks.
Yeah.
I
All
did
right,
hear
well,
someone say one time, though, just to end. I did hear someone say one time, if you want an IUL, I'd rather you get a whole life and have your dividends by indexes. If you want the upside of the index, I'd rather you do the whole life anyways. So anyway, there's a weird idea. If you do really want to get in the stock market, you love mutual funds, and you'd rather it be internal in your policy, you can always add that on.
That's actually a great reframe. Yeah, just give them what they want and let them do that. But I still hate it. But it's better than having an
Better
IUL.
than an IUL, yeah.
Yes. And we love everybody. We don't have a thing against IULs. It's just when you have people coming to you all the time telling you what's happened to them, it's kind of hard to stay neutral at some point. We love you guys. We don't want you getting screwed over. So Snaggy, take us home, brother. You're just doing your hand thing. Come on.
Yeah, I get to talk finally. Yes. I'm thinking if I guess my hand's moving. So we learned something about me today. There we go.
I didn't see your hands moving very much, bro.
That being said, thanks for being here today, guys. We'll see you very soon. Team, appreciate you guys.
Bye, all.
See you next time.